Can't give you a formulaic approach because I don't use one. If you want a formula, you should go back to graduate school. They'll give you lots of formulas that won't work.
Charlie Munger is one of the most prolific names when it comes to investment. The American billionaire investor, businessman, and former real estate attorney is the vice chairman of Berkshire Hathaway. Munger plays an important role in the conglomerate, which is controlled by Warren Buffett. Buffett has even described Munger as his closest partner and right-hand man. So you can think of all the experience Munger holds is extremely crucial for an investor's point of view. That is why his words hold a lot of value when it comes to getting high returns on stocks. In this video, we bring to you 7 such principles of Munger, which will help you a lot in getting those high investing returns. So make sure to watch the video till the end. This will help you a lot in getting those high returns on your investment, which you might be looking for. Number 1. Measure the risks thoroughly. Most people, when they buy a house, happen to do their due research about it. Is this house in an area that's subject to any natural hazards? How old is the house? Has it been well maintained? Are the moisture levels high? Are there any plumbing issues? So people happen to assess these risks before buying a house, but when it comes to buying stocks, for some reason people forget to do this. Charlie Munger has a couple of things to say about risk and how to mitigate it. Firstly, you need to include a margin of safety in your investments. That way, even if the things were to go bad and the business struggled, you would be fine because you have that safety level buffer. Munger also advises to avoid people and management with questionable character in the long term. This is just going to give you unnecessary headaches and increased risk. Now, even if you happen to invest in a stock with the risks involved, you need to think upon proper compensation for the assumed risk. So if your investment is more risky, then make sure your upside on that stock is very high. Sometimes inflation and interest rates exposure also pose a big risk to investors, and therefore investors should be well aware of this fact. Number 2. Independent investing. Of one thing be certain, if a CEO is enthused about a particularly foolish acquisition, both his internal staff and his outside advisors will come up with whatever projections are needed to justify his stance. Only in fairy tales are emperors told that they are naked. Munger's longtime business partner Warren Buffett said this once, and Munger seems to lead by it too. In real life, everyone tells emperors what they want to hear because it makes them feel good. It doesn't matter if it's truthful or not. So that's the group mindset searches for consensus, whereas individuals search for only the truth. Now, that's an important thing to know while being an investor. This is in fact one of Charlie Munger's highest values to achieve investing success. He wants investors to be objective and rational. And one of the best ways for this is by being independent. When you are independent, you're not forced to agree with someone to make them happy or ignore the truth to keep your place in a group. When you're independent, you can simply look at the data and analyze the facts in order to search for the truth. Charlie Munger teaches that just because other people agreeing or disagreeing with you doesn't necessarily make you right or wrong. The only thing that matters is how good your analysis is on the facts. Munger even has an example of this fact for you. In 1929, everyone thought it was a great time to invest, but in hindsight, we all know what was to happen. The stock market was overvalued and it crashed. Even in 1999, when the whole herd of people thought it was great to own technology stocks, and they would make you rich, the tech stocks were just about to hit a low. If during those times, one could have just stepped back and stayed independent, looking at all of the facts before investing, his decisions would have been a whole lot better than the group. Number 3. Study your stocks. Without the method of learning, you're like a one-legged man in an ass-kicking contest. It's just not going to work very well. Munger said this in his book, Poor Charlie's Almanac, and it's entirely true. To be good at the investing game, you have to be prepared and ready at all times. So first of all, you have to learn all the basics and the ground rules of investing. But it's the daily practice of studying different stocks and keeping track of the market which really helps an investor. Munger says, having your hand on the trigger ready to pull when the opportunity strikes is something you can only learn by the virtue of studying. Sometimes opportunities won't come for a while. The market could be stagnant or it can be overpriced. Nevertheless, we should still be constantly reading, learning something new, and just being curious about what's happening. Being ready and waiting for the next deal to come along is the success mantra. But acknowledging what you don't know is also a big factor. A big problem in today's society is that people think that they know everything. But when you actually start digging, they don't really know what they are talking about. While this can be good for a fun conversation, when it comes to investing, it's not so good. Because you're not actually studying the facts, you're just pretending to know the facts. Munger advises to stay within a well-defined circle of competence. He says to identify disconfirming evidence and resist the craving for false precision and false certainties, etc. Above all, never fool yourself. Remember that you are the easiest person to fool. That is a humbling thing to know, but it's true we can fool ourselves very easily. This can be avoided by regularly studying your stocks. Number 4. Allocate wisely. The core job of an investor is to allocate his capital. Where to invest? That's the most important question. Keep it in cash or invest the money in real estate. Or perhaps put it in stocks. But which stocks? Definitely, our money has to be somewhere. What we need to do is to compare the risks and rewards of each option, and only then decide which investment offers the best opportunity. Also, when a good opportunity comes along, do not be afraid to allocate heavily towards it. Charlie Munger says that he has just waited for opportunities throughout his career, and when they finally did come along, he pounced on them. The Munger family owns only 3 investments till date: Berkshire Hathaway, Costco, and Leilu's fund in China. While it is not a very diverse portfolio, it surely is a rewarding one. Charlie allocated big on all 3 of these because they were such good of an opportunity, and they proved to be so in the long run. Number 5. Patience is the key. Patience is the key. The big money is not in the buying or selling, but in the waiting. Munger is a big propagator of keeping patience in investing. As humans, we constantly feel the urge to do something or the other. If we are at home, we tend to clean our kitchen and garage, or do a workout, or make our bed. Action feels good for us humans, but with investing, often the best thing might be counterintuitive. But it's sometimes more favorable to do nothing. If there's no opportunity right now, don't worry about it and just keep learning and sharpening your experience in your toolkits. Wait for the very right moment and don't feel the need to do something always. Even the great Albert Einstein said that compound interest is the 8th wonder of the world. Naturally, if you own stocks, compound interest will do its magic. It's just going to keep building on itself. And the best part, we don't need to interrupt it unnecessarily. Once we have invested in a particular stock, we must let it do its thing. Just don't take action for the sake of taking action. Number 6. Be decisive when the moment calls. Refrain from taking unnecessary action, but just be decisive when once in a while an opportunity presents itself. Munger mantra is, if you're in a game long enough and are studying the market diligently, you will definitely spot them come along. Just like buying oil in 2020 or buying Apple stocks in 2016 like Warren Buffett did. These were the opportunities that were taken after studying the market well enough. These stocks were pretty certain to go high anyways, but when these opportunities came along, the investor in you had to be decisive and act with conviction. Even if the whole market might be saying, don't buy it, it's going down, stay away from it. But you need to trust your own independent research and instincts and not be afraid to act when the opportunity strikes. When opportunity meets a well-studied and smart mind, miracles happen. Number 7. Change when it's necessary. Throughout their entire career, both Warren Buffett and Charlie Munger have steered clear of technology stocks. Being octogenarians, they just do not seem to understand the modern technology world as well as they want. After all, it isn't something they grew up with, and that's why Berkshire Hathaway refrained from investing in tech stocks. However, after nearly 50 years of investing in some particularly successful ventures, they made a change. Buffett and Munger knew that the world was transforming and technology was growing. And when they saw opportunity in certain tech stocks around May 2016, Berkshire Hathaway started purchasing stocks in Apple Incorporated. Their investment paid off big time as Apple grew into a behemoth and even catapult their stock position extensively. This was possible only because they were willing to adapt to the changing world, yet sticking to their same circle of competence. This is a vital lesson for all the investors. Hold your beliefs high enough, but also don't be too stiff to change them once you spot a particular opportunity. What do you think about Charlie Munger's advice? Do you think it would help you become a more profitable investor in the long run? Tell us your views in the comment section. Also, press the like button if you like the information and tap share to share this video with your fellow investors. Do not forget to subscribe to our channel for more such videos. We will be back soon.